Well, good morning, good afternoon, and good evening. It's Monday to the one of the shortest weeks of the year when it comes to trading, and this is Doc here from North America. So we're going to get rolling along. But that description I just gave you means that my mind is already thinking that it's Friday. We have Monday, Tuesday, and Wednesday, and then by Wednesday afternoon people are starting to do all kinds of other things because it is Thanksgiving, and as much as these some of these politicians in some states that are running states are trying to lock us up, there are other states that are free and we're able to travel and be free. So then Thursday is Thanksgiving, and then Friday even the New York Stock Exchange is closed half a day. So it just shows you it's like a 4-day weekend. And it is always welcome, that's for sure. Alrighty, let's get rolling along here. We're looking at the Swiss. That's where we start off nowadays. We used to start off with the euro, but we've really come to the conclusion at the moment, everything changes in trading. One moment it's working, and the next moment it's not, and sometimes they stay consistent for weeks, months, and years, and then they stop, and so forth and so on. And right now, we do see a strong correlation between the way the dollar is moving and the Swiss franc compared to other currency pairs trades. So you can see here, the dollar is going down. That's on our Chicago quant chart. And then right here on our J4X, you can see the same thing. It's trying to move down. You can see the white line and the dotted line are moving up. So trying to show some strength there. You can see our work, we're already rolling over. This on J4X coordinates about 70 some odd percent of the time, anywhere from 68 to 72% of the time. It fluctuates back and forth to our mathematics. So it's always a good thing to have if you don't have anything at all and you've missed Doc's webinar and you want to see where the potential is. We're using Hinky Ashy candle bars. That emulates our dots to a great extent in the 68 to 72 percentile. And then we're using a relative measurement in the sense of we're looking at two different stochastics, a fast one against a slow one, and a CCI, and here is the purple. And so put those all together and you get a little tool that gives you a better direction than nothing. Hassan, good morning, good afternoon, and good evening. I am doing fine. I just fed the chickens and went down the hill to the other side of the farm and fed the chickens and had everything prepped so I could walk back up and into the office and start to pontificate about the world and its financial markets. I hope everything is good for you. Hope everything is peaceful and so forth. And anybody who's new here, you just want to see something, just throw it up on the chat line and we will stop what we're looking at and jump right to whatever product you're interested in looking at. If it be looking at. If be it gold, if we can figure out where that's at now. There it is. Let's see who's that. That's crude oil. If it's crude oil, Jan oil there, or silver, which is trying to sell down a little bit there, as you can see. Or what else? Or, as I said, gold, right there. See, it's a little pressured on there. And we can explain to you all our math, and we've just explained to you the J4X math. In your experience, what is the easiest financial market to trade for Forex, currency, pairs, stocks, metals? Good question. It fluctuates and it goes in and out. It's a good question because, in trading, there's really not anything that's easier than the other. But what makes something easier or possibly easier? Let me see. What are good attributes? In other words, what are good things that help trade a product? I think I'm saying that right. Let me see if I can say that a little bit better. In other words, liquidity. In other words, if you're going to get involved in a product, the trade, you want liquidity. You want a lot of participation. Okay, that kind of answers that question. That's part of it. Your experience. That's part of my experience right there. Liquidity. Second of all, options. If they have listed options and they're an active option, in other words, there's a lot of participation. That's a good thing. So in other words, when it comes to the currencies, the euro, then the British pound, and then it gets a little bit thinner because the options are relatively dead in a lot of the other products. I think. And I'm reading the question over again. What is the easiest financial market? So no market in particular is easy. It all comes down to their liquidity and the tools that they have that are liquid. Per calculation, I have to say that the currencies do move the best. I have to say that. That's a good question. I think the currencies, the currencies overall, especially after quantitative easings start in 2008, I find all the currencies to really like my Chicago Quant tools. You know, I really find them to be very accurate. Wow. Hey, Ferris. IVB. Good morning. And I guess you heard my pontification of it's like a 3-day week for us in America. Now, I'll be doing the webinars. I have no problem doing the webinars all 5 days. But because I always have something to say about something. Doc has an opinion on everything. Or if I don't have an opinion, I can find one for it. All depends on what you want to see. But yeah, I'd say the currencies, they're the best. Obviously, fixed equity or bonds and notes are the most traded in the world. But they can move very irrational at times, more than the currencies do. And then let me think, because of the liquidity, they're not really listed. The only product that is listed is the futures contracts. And so bonds and bills, corporate and and government are can be hair trigger once in a while. What I mean by that is one moment they're trading and looking, oh, this is pretty cool. And then the next thing you know, there's some type of news that comes out and they drop so dramatic or rise so dramatic that you can't even participate with them until after the event because there's not a listed market. In other words, like a listed exchange. So, bonds are the most liquid in the world and at the same time can be some of the most hairiest of products to trade on a given month or year. You don't get insane moves like, every 3 days or something like that. It happens like once or twice a year or, once or twice every couple years. But when it happens, it can be death defying. One moment you're here and the next moment you're, 3 percentage points away. And it's like, what? How did that happen? Why do currencies always move opposite to our open trade? You mean your open trade or just, let's see, in other words, why when you buy a currency or sell a currency, it seems to go the opposite direction? Just your technical tools, I'd imagine. We get a lot of instant gratification out of our mathematics. They are fluctuating, and they're the second most traded thing on the planet. And so they're also the second most liquid product on the planet versus the bonds. I think I was describing it to somebody. If you took a look at, bonds, then currencies, then commodities, divided up the commodities, say oil first, and then say the metals or the grains, and then, in that commodity slice or tranche, and then you went to the stocks or stock indices, however you want to play with that. If you took a look at all those, if you looked at those products as I described them, bonds, currencies, commodities, and stocks, basically, bonds are, if you took it like a train or an automobile, one train car or one automobile, basically bonds are equal to 50% of the vehicle. You know, in other words, that's how much that's how much activity there is in them, and how much equity is in them. Okay, in the world. And then second of all would be, say, currencies, which would be like I guess about half of that, maybe even less. And then from there, commodities, mainly starting off with oil, and oil is like the third most active product, and that would be like a row of seats in an automobile, say. And then then you go over to some of the other commodities, like, you know, grains, you know, soybeans, wheat, corn, and so forth. And then you look at metals, and, you know, all those. They're like the headrest, you know, size type of thing. And then you go and look at the stocks. They're like the windshield. That's about as thick as they are. I mean, stocks are there's a very small amount of them trading really on the planet. And so as much as you think that they're like a dominant factor, they're not. The bonds are, you know, half the automobile. Currencies are a quarter of the automobile. And then, you know, like oil is like a row of seats in the automobile. And then the size of the rest of the commodities from there can be like the headrest. And then, you know, that type of thing, all the way to, you know, if you're trying to figure out the width of things and so forth. You know, so and then the stocks are very small participants. Okay, so I hope that helps out. Just for fun, why do currencies always move opposite of the open trade? I guess it's, like I said, it's your technical tool that's making you decide when to get long or short. Remember, what gets you in gets you out. All right. So let me think. Where am I at? Okay, so here we are. We start off with the Swiss franc. Let's go back to the Swiss franc. Right there. You can see it's moving down. So what that means is that the dollar is moving down. How do we How do we decide when to close the trade and get the profit if the market is still moving in your direction? Well, I think first of all, we've had a conversation about this, and I love reiterating it. I mean, I find it to be very important, and that is that the old saying "let your profits run" is from the pre-1975. Okay, and that's from an era. Let your profits run comes from, you know, the 1930s and 1920s, you know, 1880s, you know, that type of thing. It's from a bygone era that doesn't exist anymore, because once they created listed options, or legalized listed options, I guess that's the best way to describe it, legalized listed options, and put them on listed exchanges and make them functional to trade, that removed the zero-sum factor. And so you can't really tell. The days of let your profits run was when there was longs or shorts, basically. And that was it. And now, with the zero-sum factor removed, longs and shorts are not defined the same way as they used to be. So you can't really let your profits run because the volatility has increased dramatically compared to those days. See, volatility was very low when they philosophically described let your profits run. So when you say, Hassan, how do we decide when to close the trade and get the profit? It's when you have a profit. I used to say in the early years when I started with Dukascopy, I would say, if you have a position on and you're making money in it, if you don't take it off when you're making money, the next time you're taking it off is when you're losing money. So obviously, if you always take profits, then you're not losing any money. So you can't really use that old idea from pre-1975, let your profits run, because volatility back then was enormously small. In other words, stocks would go a half a point in a year. Now they go like they go like half a point in a minute. And so you can't really, how can you, if you're using that same measurement, then when stocks could go a half a point in a year, and now they go half a point in a minute, well, then obviously you would take a profit after a minute. See what I'm saying there? As I take a bite of a cracker. Does that make sense to you? I would hope so. Let me see how far back my... there you go. So that is really the nature of the markets, and we have an expression around here also. We used to use it on the trading floor. What gets you into a trade gets you out of a trade. So in other words, if you bought something, good. Okay, so I just want to make sure I'm not sounding too crazy. And so we used to say on the trading floor, what gets you into a trade gets you out of a trade. So in other words, if let's say you buy something, you've done your research, your technical research or fundamental, whatever is making you trade, whatever making you proactive. Remember, on a trading floor, and that's another thing too, is a lot of people write these stories and they're reactive stories. They're not proactive stories. And so what happens is that reactive stories are from people who are on trading desks and exchange floors. So in other words, an order is coming at them, a bid or an offer, and someone's looking to make a trade, and they call them or they yell at them or whatever, and they make that execution. Whereas nowadays, the exchange floors are dead. The trading desks are almost gone. They're non-existent. And so what happens, we are now all proactive. We have to create an idea. We have to search for an idea to trade. We have to invent an idea. And then we have to decide how we're going to trade that. What's going to be the decision-making process? Is it technical analysis? Is it a fundamentals? Okay, if it's fundamentals and you're saying, I like this because of... Let's use the cryptos. Cryptos are a really good example of fundamentals that you can really trust more than ever before, and in this era, because fundamentals now are pretty much with quantitative easing are pretty much disrupted. So we know one thing for sure: these cryptos have a limited amount of inventory. Like a Bitcoin is only going to be so many Bitcoins, and then after that, they're not making any more of them. Okay, so that obviously that helps a supply and demand situation, and they are becoming. I read more statistics where cryptocurrencies are becoming a substitute for the metals market, and so, we know that there's going to be more demand because they have a limited amount that they're going to produce. They are somewhat like our Social Security system here in the United States, or like a pyramid scheme. Except for, whereas Social Security invests the money, or has a lack of investing the money actually, and whereas the cryptos, you're just buying them on the idea that other people don't trust the rest of the world, and they only trust now the cryptos, and so it's kind of like a pyramid in a sense. It doesn't really do anything but give a level of security that it's going to exist. Okay. And so, how did I get to this conversation? Let me think. So the cryptos are more of a fundamental in their own limited way, whereas if you're buying a stock like Apple or something like that, Apple Computer or Intel or Amazon or something like that, you're trying to speculate on their sales and their production and their cutting edge position in their field. That's a really tough fundamental to really try to chase after at times. So that's the whole key there. So when I say what gets you in, gets you out, you have to decide if you no, yeah, that's how I got there. And so what gets you in, if you're using technical analysis, if it doesn't go the way your technical analysis said it was going to go, you have a stop or a limit. Don't reinvent the trade. Like I bought it and now it's down for the last 2 hours. My technical work still says be long, but I'm losing money. Am I going to get out because I'm losing money, or am I going to let the technical work get me out? Now you've done all this research. You've put hours, days, months, weeks, whatever, into the technical research, and now you're trying to trade with that technical research. And the moment it goes the wrong way on you, but not the technical, but the price, in other words, you bought it or you shorted it and it's going the wrong way, all of a sudden now you're going to, redefine the trade. You don't do that. If technical analysis got you in, that same technical analysis will get you out. Okay? That's what you've been doing the research on. If you're using fundamentals, the fundamentals that got you in, that you've been practicing and back testing on and researching for hours, days, weeks, and months, that gets you in, that gets you out. Okay, cool. All right, so I hope that makes sense. So, back to your original question, what is the best products? To me, some of these currency pairs that are considered exotic ones, say like a Kiwi against the dollar, or Kiwi against Canadian, or something like that. The loonie trade, or other of these trades like Euro British, not Euro British, British pound yen, or some of them that were not very exciting at one time seem to be way more liquid ever since quantitative easing after 2008. So they can be some good trades in there. Maybe a little less noise in the background, which is kind of nice. Because remember, we're trading them not necessarily on fundamentals, but we're trading them on technical analysis. So I hope that helps out. But there are key points in space, in trading, not in space, but in trading. My physics kicks out of me sometimes. And that is that what gets you in, gets you out. What you've been practicing, keep on practicing. Do not, keep on practicing, working, researching on them, but don't deviate in the middle of a trade from it because you're losing money, because you should already know that's, your research is telling you, yeah, okay, it's going down, and, that's the way it goes. How do we decide when to close? Okay. I answered that. Let me think. What else is there to be answered there? Bonds are really great, but the problem is that they're not listed. Currencies are listed to a great extent and propped up by the quantitative easing more in many ways than the bonds are, as much as it seems like the bond market is kind of stable. So, oil market is always in demand. What's there, 80 million barrels a day being used, something like that, 90 million barrels a day. So there's always action in that product, and that chases after fundamentals and technical analysis. That goes after all that. And then you have your commodities, other commodities besides oil, like the metals or the grains. And now you have really Bitcoin or cryptocurrencies are really a combination of commodity. They're becoming, but they're way smaller than the stock market even. So, that's even, more illiquid in a sense. In other words, we saw Bitcoin go up to, up $1,000 and come back down $1,000. It's a 5% move in a day. It's kind of trades like oil in some aspects. I think the cryptos are probably very fascinating, and the currencies, because they're interchangeable. The cryptos and the currencies are pretty much interchangeable at this point. When it comes to, the continuity. I think that's the word I'm looking for. Continuity. In other words, they go into a trend, they stay in a trend. That's what's nice about the currencies. They have a habit of going into a trend and staying in a trend for 5 or 6 or 7 days. Hell, you look on our crazy, the fact check spreadsheet. Look at the Turkish Lira. We're up to 51 weeks now where is that thing? 51 weeks. There it is. There's the Turkish Lira. So we're 2 days in a sell and we're 51 weeks in a buy. This week we're probably heading towards the sell. Let's see where that is. Let's go over to J4X. We'll change it over there. And that's a weekly chart we're looking at on J4X. I just realized that. All right. It's like that. Let's just make that a daily. Right there. And then let's take a look at it over on our Chicago Quant. Right there. All right. And you can see there's our weekly signal, our algorithm right there. It's flirting. It's dropped underneath the time manifold from 2 weeks back, and then last week they stayed underneath there ever since they had changed the head of the finance ministry and the sovereign fund, who was the same person, and they've allegedly retired for health reasons. And so, you can see a change in the trend there. Our daily picked it up before it happened. You can see that right there. Then it tried to go in and buy again, and it dropped off again, and you can see. So the news was already being front run by the insiders. You can see here it went into a buy for a day and then fell back down again. And now it's trying to go back. It didn't close in a buy on Friday, I don't believe. No. Let's see what that says there. I think our white line's way too thick. Let's try to thin that down a little bit there. That's better. So it didn't go into a buy on Friday, but it is going into a buy. It's well above the buy number today. See, the histogram is plus, the white line is plus, whereas on Friday they were minuses. It would be plot 1 and plot 4. And today you can see they're both plus. So, and we're 51 weeks, getting ready to go to 52 if this thing starts to turn up again and gets into a buy. It may not pull the weekly down into the negative yet. This could be just a bounce. It could be just a simple bounce occurring. Whereas you just saw the first leg of the down move. Now it's going to try to correct a little bit on the upside and then turn around and roll over again and then take our weekly signal down after 51 weeks. We've been pontificating. We were thinking it could get to 51 or 52 weeks. And sure enough, that news came out. And I guess Turkey's getting tired of seeing their currency depreciate. I guess that'd be the way to look at it. So that's where we are there. All right. Anybody want to see anything? Just throw it up on the chat line. We'll go after it. And we're going to go back to looking at some of the other products. Like there's the euro. You see the euro is trying to climb just as the Swiss is heading down, which means the dollar is weak. And it shows it there too at the same time. You see we went into a daily sell on Friday. Let's check the fact check spreadsheet. That's 14. Yeah, so we went into a sell on Friday right there. But our weekly signal is still... You can see our weekly signal is still plus all the way across here. And you can see on line 14 we are 5 weeks now in a weekly buy since this starting point here. You can see we've gone up and down, and we're obviously higher than before, but it's not the most beautiful buy. You can see we went into the buy, we went into a daily sell up in here, so you weren't long for it and you weren't short for it. You were just kind of neutral for it. Because we suggest that you want the weekly and the daily to be coordinated together. And when they are coordinated together, it's a safer trade. Now, if you're using options, you have a limited risk, so then you don't have to worry about it as much. You can try to trade the downside of just this with it in a weekly buy. And vice versa. It gets into a daily buy. Right there, you can be long in both the hard delta and the options. And so you can see it's winner, winner, chicken dinner with our mathematics. And then you can see it's telling you that it's trying to correct again, and then it gets you back into a buy for this move in here. And it misses the sell there, which is really cool. And so, now we are in a sell, but you're not allowed to be short because, again, it's in a weekly buy. But at the same time, if you wanted to be that brave, you could always be long some type of put spread, which has a limited risk, so you don't have to worry about getting stopped out. That's what's so nice about the options. You don't get stopped out in options, whereas you get stopped out in the hard delta trades, And so, you can put a 2-month option on and find a way to take a profit out of it most of the time, especially in a option spread, not a naked long option or 4-week, depending on what's been going on. If it just went into the weekly buy, obviously you want to be maybe a month, 3 weeks. And so you buy it here, and a week later, it's that far up, and more than likely because of the option spread, it's making money at that point, even with it dropping, 200 pips. And, and if it was a hard delta, you get stopped out, done, trade's over with. And so that's what we're saying here about that. All right, let's see. What else can we talk about here? Let's go over to cable. We always do the cable and take a peek at that. You can see cable doing the same thing. Daily buy there for a bunch of days right there. We're in a weekly buy since here. Obviously, that's a little bit more less painful than the euro weekly buy is. It's obviously been a winner, winner, chicken dinner. Gave you a nice instant gratification there. It tested it, brought it back to the 0 line, and then another explosion up on the upside here with that buy right there, and then zoom to the moon again. Again, winner, winner, chicken dinner. And so then, let's see what other products we usually chase after. Let's take a look at the Canadian. We already took a look at the Turkish Lira. And you can see, usually we go to the Turkish Lira from there, and then we go to the Canadian. Now, what's curious is that usually the Canadian and the Turkish Lira have a tendency to move in the same directions. In this case here, you can see it went into a, let's grab this one. Or do we create one? I don't know. Let's see if there's a sell line that I don't have to create. Yeah, let's take one. Just move it over to there. And we're going to slide that in and make it a little bit thinner too. And you can see last week it closed in a weekly sell, and you can double check that by looking at the fact check spreadsheet. There should be a number in there. Okay, right there. And that is line 20 on the fact check spreadsheet. Oh, you can't see the lines. Can you see the lines? No, I don't think you can see the numbers. That's it. So let's move it over. There we go. So it's line 20 right there. Right there. And so what we got there is 1 week in a sell now, starting on Friday officially, and 4 days in a sell. So the daily led us down. Now, it doesn't seem to be the most exciting trade in the world. You can see it's just been kind of hanging out. Went into the sell right there. Off of that one. 1, 2, 3, 4. Yep, that's the one that went off into the sell. Right there. Let's get rid of that and move it down. Remove. Let's steal this one. I don't even feel like making one. Right there. So it went into the sell here at 131.06 and has traded as low as 130.39. So what's that? 61.06, 67 pips down. And it's bounced back up and down, but still stayed in the sell, as you can see here, because the white line is below this zero line, and the histogram is below it, you know, and so forth and so on. And we got, doesn't matter about the green and red dots at that point, as long as it's minus. And so, if anything, you used it to make a cover or something like that. See, I heard that major central banks can easily manipulate the major currencies. Oh no, yeah, there's no doubt about that. They seem to keep them in channels or bands. They seem to keep them locked in an area, and you notice every so often they come out with odd messages like, "Oh, that country is not what is it? What is it they call it? Not manipulating." That's it. You know, so and so that's always, you know, that's it. You know, that is the answer to it all. You know, in the end result is that they keep them in. I guess it's safe to call them manipulation. There's no doubt about that. But they definitely keep them in line, because you can hear them every so often. Oh, they're manipulating their currency, and you're looking at it and you're going, damn thing ain't moving that much. Why is it manipulated? So obviously, you know, basically, you have to kind of sit back and wait. And so you got to wait for them to make an announcement. You laugh at it afterwards, of course. But yeah, if they're not moving that much, you know, and even when they do move, sometimes you see the yen take off, and I'm thinking, oh, okay, they're going to say it's manipulated, and then our Secretary of Treasury comes out like a week or a month later and says, oh no, these currencies are doing fine, you know. It's like, okay. Then sometimes they say, oh, this one's being manipulated. It's like, well, they don't look like they're trading any different. So, you know, they obviously have something we don't know what it is. And I have to assume it's a combination of volume and range, or a band or a channel that they're watching relative to other things. I don't know. You know, they obviously have some criteria that they're not telling us what it is. And so that's that seems to be the answer to it all in the end. So, and I guess that's about the best way to describe it. So, you know, based on the number of people going long and short, they can move the price. I don't know if it's about the people. Like I said, I think it's got more to do with I don't think they're trying to trap people. I don't. I think that they're just, you know, they're allowing the price itself to define itself. That's the only thing I can figure. I mean, I can't imagine them saying, oh my God, there's 75% longs. Let's sell the thing. I don't see them thinking that way. I don't. As far as they're concerned, as long as it stays. Remember, they're not trying to trap people. They're trying to keep things stable. They're working towards stability. That's their mantra. They're fighting for stability. So they don't really care if there's 100% of the people are long in it. As long as it stays in the range that they want it to stay in and stable, I don't think they really care. So I'm not like looking at it and thinking, no. They're not like the New York specialists were, years ago when the markets were controlled by a small group of people at the exchanges and the institutions. Those they would try to trap people. They would try to trap the longs. They would try to trap the shorts. Central banks are really fighting for stability. They want the mutual funds. I don't know about the hedge funds as much, but the retirement funds, the pension funds, they want all those to stay stable. That's all they're fighting for, is to keep them stable, currency-wise and equity-wise, and asset appreciation. That protects the governments. Remember, there's a lot of governments that are responsible for the pensions and and so forth, and the pensions have been abused on many levels. Here in the United States, most of the union pensions have lost anywhere from, 50% to 65% of their assets, through mismanagement. And so their retirees are receiving 50 to 65% less. There are very few pensions out there that are still paying 100% of assets, especially in the union universe. So they're not maneuvering inside them to control longs and shorts. They're maneuvering in there to keep stability, that's so that they don't go up or down much. Cut out the volatility. That's what they're really out there fighting to do. Does that make any sense? And so that's where we are there. Ooh, that's not right. And so that is about it. And so what else do we got going on there? I guess that's about it when it comes to that type of talk. So we can drift over to... Okay. Let's drift over where we're at now. Oh, we're looking at Canadian. Okay, so that's usually where we start to slow down on the currencies. We go over to the New Zealand against the Canadian. And then obviously if anybody wants to look at a currency pair, we'll put it up there. And here's a good exotic. Notice the distances between the buys and sells. There's a lot more continuity in these lower active products. You get into a sell here, it travels for 5 or 6 days or 7 or 8 days. Get in a buy here, it only lasted, but it was a good little spike at least where you could make money out of it. Now this one here is classic. It basically doesn't go down at all. Barely goes down to the point where it goes into the short or the sell, and then you can see it jumps back into the buy, and we're in a weekly sell to begin with, and so that's kind of tough to take that long. But notice there is a consistency, and the distance. There's a lot of consistency in these smaller pairs trades. Here's a nice one. It's really good. Here it gave you a good profit after a couple days. These are interesting. Now this particular pairs trade leans into the oil market. It kind of follows the way the oil trades. Let's see. Anything on gold since Oxford also announces that the COVID vaccine efficiency. Let's take a look. I think we looked at it a few minutes ago. At the very beginning, just to run through describing the different width or depth of markets. So here we go. You can see here gold is down. It's heading for the lows of the last couple of months actually, which is interesting. Let's refresh it. You can see here that that was the last. There's like 3 or 4 cures now for the vaccine. The 3 or 4 vaccines out there now, and they're all very efficient and very good. And so you can see that played it right there. that one right there, but it hasn't really done anything about it after it. You can see here where they tried to get down to it, it kind of failed, but we've been in a sell on gold now since that thing there. We were in a weekly sell for this, and which is funny is it goes into a weekly buy here, and it stays up for a couple of days, but not even a green dot. It's kind of dead, doesn't really have any life in it. For silver, same situation. Let's reload that. As you can see there, it was in a daily buy coming in from Friday, and actually it's been in a, how does that get into a sell? I guess that should be removed because it never got into the sell there, and that shouldn't be in a buy then. You can see this has been up. Now we've gotten some bad. We get a data feed from a major brokerage house, so I don't understand how they seem to change the numbers on us overnight sometimes. It happens once in a while, which is really irritating. And so you can see here, it is now flirting with, oh, wish I hadn't canceled that sell. Darn it. Let me go grab another sell. We don't need them back here. So we'll go like that. You can see there, it is trying to flirt with the sell at the moment, right there. You see it's trying. But it's been trapped in a sideways. This is a channel right here. This is what I mean when I say a channel. Here's a channel right there. Let's make that a black line or a black dashed. So there's like a channel developing, and there's a low channel and a high channel developing. It seems like they watch these channels or bands or however you want to describe it. And when you scrunch it, you can see it becomes even clearer going way back to here, and you can see this is the 7-year high right here, and then it develops another channel right there. You move that up, you see it's playing with the bottoms here and the highs there. See how they're playing with that? They seem to be the banks and all seem, not the banks, the central banks seem to be, and the Treasury secretaries and Treasury ministers, finance ministers seem to be talking about channels the way they describe things at times. They don't say it's a channel. They don't say they have a band, but what they do say is they can tell when it's manipulated or not. And to me, I think that's what they're looking at. And then obviously they must be looking at volume on some level. I don't know. It's a combination of all of it. Let's see. Hassan says, will gold start going back or still a chance to break from 19 to 2000? We'll just follow our numbers at this point. So when we go back to gold, right, where's gold at? Right there, and we scrunch it up, it looks like a big correction to me. That's what that looks like, is a big correction. I read some articles that talk about the idea that people are moving, institutions are moving out of gold and buying the cryptos, especially Bitcoin, solely because they have options, so they can hedge them, options and futures they have on them, besides the actual Bitcoin itself, so they can justify, to their investors that they can hedge it. Let's see. Oh, hey 54, how you doing? The problem is that the bubble is being created in assets, and the excuse is preserving the pension funds. In the process, we are creating the biggest bubble assets in the world has known. I guess, the world has never been this connected. That's why I have a hard time saying that this is like, there's a historical period we can look back at and say, okay, this is greater than that. See what I'm saying there? So, in other words, I agree with what you're saying. The problem is that the bubble is being created. I agree there's a bubble being created. But who's it being created by? And that is by the central banks that create the rules and create the laws, and with the blessing of the governments that create the laws. So, we've never had, let's put it this way, 100 years ago, I guess, in right after World War One, I guess we had, currencies and metals. A lot of currencies were backed by metals. So there was like a physical relationship that you could fundamentally look at. And so you could say, okay, historically, there was something there. And you could go back a couple centuries before that. I used to say this to Robert Prechter many, many moons ago at the Market Technicians Association. I used to say that you could go back to Lady Jane, where she converted, I guess, the pound from sterling from copper, or the, that type of thing. I guess, it's hard to compare it on a century over century situation. I think that you have to really go back to 2008. Maybe I want to say that the birth in many ways was 1930. With the central bank playing with these things. You have to take Bretton Woods and the dollar being backed by gold, and under Richard Nixon in the 70s, being removed, or 68 or whatever it was, 68. So Bretton Woods was like 69, 70. So I mean, you have like basically, what is that, 50 years of kind of a history of some form. But it's awful hard to try to compare it to, hundreds of years and so forth. I mean, metals were definitely a tool, and and a lot of times wars were created to take over small countries that had some good gold reserves, metals reserves and so forth, and resources, natural resources. So it's 54. I agree with you that there's a problem that a bubble's being created. There's no doubt about that. There's an asset bubble. There's no doubt about it. But the thing is that it's not measurable over the centuries. The process, and you say, in this process we are creating the biggest bubble asset in the world has known. No, I don't think I don't think you can say that, because I don't think we've ever had this type of coordinated effort by countries on a peaceful level for trade and commerce and linked live. I mean, it was slower moving. People made decisions over weeks and months. Now people make decisions over minutes and hours. It's a strange animal we're in. Very strange. Hey Daniel, how you doing? 18,000. Where is that now? Let's take a look at it. Is it back up over 18,000 again? I want to keep on exploring what 54 was talking about, because I think that it's a good conversation that we need to have, because we may be able to figure out what is going on there a little bit better and be able to identify warning points and so forth. Yeah, you can see there it was as low as what was it? The low was 18,230 today, and the high today is $19,040. And right now we're off just what's that? 19. What was the high? So we're off 335, $370 off its high. We've been in a daily buy and a weekly buy for, as you can see on the spreadsheet. I guess we should move the Bitcoin next to the. I guess we should take this and move it next to the futures contracts. We're now 10 weeks in a weekly buy and 31 days in a weekly buy. So, product's been in a buy for a while now. All right, so 54. Yeah, I'm with you there. There's the bubble being built. I agree. I just don't know how to measure the distance of it. In other words, how long has it been around? How do you compare it to previous bubbles? So forth and so on. It's a little bit thinner. Imagine this too. Remember, now compared to some of the last great bubbles, we have central banks now stepping up, and when there's weakness, they're stabilizing the markets. But the volatility is massive. We saw in March we saw a fall, 33%? I mean, it's a hell of a move. And we saw 33% come back in a matter of weeks, so with a V-shaped bottom. So, I'm there with you. I just don't have enough input for you to say yay or nay, yes or no, You see, Daniel says the Turkish Lira seems to want to turn around to. Yeah, we were talking about that. We're thinking. Let me just throw it up there for you. We were thinking that. At least I was thinking. Let's see. Let's go back to it. we're thinking that this is just a corrective bounce up, and then maybe it'll take another move. So in other words, this is like the A, and then there'll be a B, and then they'll take another move down. As you can see on the spreadsheet, we're 51 weeks now, right here, in a buy, and 2 days in a sell. So the sell has been a very poor sell on that one. Let's see Daniel Forex, one of the let's see. Oh, here we go. Daniel says, okay, so throwing in free money. Yeah, see, that's another thing too. Is it's not like the 1930s with inflation. We don't have that. The central banks are propping up institutions like, banks, and those banks are not allowed to lend money like they used to lend money. So you can't get the inflation that we normally get. That's why the Fed has had a problem with the inflation, because they limit how banks can lend money to begin with. So they print all this money. The banks are sitting with this enormous amount of money, and they're not allowed to let it do anything but invest in government bonds. It's like a self-fulfilling prophecy. So they print the money. They float bonds to print the money. The money that's floated, they buy the bonds. And so on a balance sheet, in many ways, it's a zero. There's no gain or loss. So, it's really weird. So a central bank creates money out of thin air. Now, how do they do that? They create bonds. Okay, and so then they give them to the major banks in the world, and institutions, can be hedge funds too, and or pension funds, and then they force the pension funds by laws and rules to go buy the bonds they just floated. So it's kind of like on a balance sheet, in a debit and credit, in financial accounting, you almost have like zero in assets. So they're not creating assets and lending them out to anybody to start a business or start a company or start something. Instead, they're lending it to institutions that now go back and buy the bonds that they just floated. It's weird. Very weird. Extremely weird. Okay. Let's see. Daniel says, that's the answer to that free money thing. It's weird. I'm there with you. It's there. I know it's there. We all know it's there. But we also know that they don't lend it to anybody. They end up forcing them to buy bonds. That's why there's, 15 trillion in bonds that pay nothing, and you have to buy the bonds and pay to own those bonds at the same time. Well, that's so weird. Not million, not 15 million, not 15 billion, 15 trillion. So is that 15 trillion really a zero in the end result on a balance sheet somewhere? In other words, is it really there just to begin with? If they're being forced to buy the bonds that were floated to create the money. It's a very weird thing. Hey, AR, how you doing? Okay, so let's go back to answering more questions here. Daniel says, in Forex is one of the most manipulated markets ever with one of the most little net gain. You need to use 10K leverage to get 50% gain, while in stocks you only need to hold. True. I hear you there. I kind of described it as, how have I described that? Forex has better continuity of direction than most other products. Stocks are more choppy. They're thinner. Less volume in them. And, just overall, the central banks are trying to keep everything in line in the end result. So, yeah, they're controlled by a strange... Yo, dude, it's Adele. Cool. I like that. Dude. I like that. Sends me back into the 80s. I think that's really cool. 1980s, 1990s. Dude, it's Adele. Let's see. On stocks or cryptos, you can hold for no risk you have risk. You can't say there's no risk, but it's a limited risk. It depends on your leverage. If you leverage it too much, you're going to get knocked out. If you hold them in options, and option spreads, obviously a lot easier. If you hold them in just hard delta, you have a margin situation. For 50% gain, while Forex with 10% leverage, you are at risk of being stopped out. Right, exactly. This is why Forex is not useful except for Turkish Lira, then it goes up. All right, I mean, I think overall you marry them with options and you'll have no problem. You can do a hard delta and options simultaneously. So, it's a combination of both of those. Trading tools are really important. We have conversations here a lot of times about trading tools and how do you, understand the trading tools and how do you use the trading tools and so forth. And those options and hard delta, the underlining product and the options are important tools. Pairs trades, obviously you're betting that one is going to go the same way as the opposite of the other. And that's not always true. We see that surrogates are used. Metals and commodities for dollars, gold, silver, copper. Soybeans can be used as surrogates for the dollar. So they could buy euros, not sell dollars, and they move kind of a little wonky, and then they can be using, sell like, soybeans or gold or something like that. I find currencies useful, just not, for a manufacturer or a purchaser of foreign goods, they're going to use them. They got to translate it into the local currency to deal with the inflation. I see. I said hey to AR. Hey to you. The rich is getting much more richer, and the poor is getting poorer. Well, under Trump, the poor is not getting much poorer. They've been, actually getting more income, and their assets have been a little bit more stable. The effect of social peace at some point, as the richest 1% of the population control more than 50% of the wealth. Yeah, again, I'm not into socialism, so I don't really care. I'm a capitalist, and I trade markets, so I don't really pay attention to that socialist stuff. I don't find it to have any value. There's no socialist country in the world I would want to be invested in. Your Ether, yeah, that's a crypto is now winning against Bitcoin, right? I would be nice if they would create options against that. I would love to see options and some type of underlining product like a ETF or a futures contract. That would really make that product really nice. Let's see, I've answered the dude. And there we go. Okay, so I've gotten pretty far. Let's see, 54. Real rates rising big time around the world. That will send stocks higher, dollar down, and gold hard down. I'm not into the fundamentals. You know I don't trust those things. I warned you 12 months ago about trying to use fundamentals as a way of trading. It's dangerous. It's just plain out dangerous. And why is it dangerous? Because the central banks, as you said all the way up at the top, they're basically controlling the whole structure of things. And I think I've identified what it is, and that is they want to keep that stability. So it's really hard to use any fundamentals to describe, to me it's all technical analysis. The central banks seem to use technical analysis way more than they use fundamentals. But that technical analysis is to lock in stability, not fundamentals. Lock in stability. And I think you're totally right on pretty much what you write. It's just I think you have them kind of a little jumbled around. I kind of agree with almost everything you're going after there. Richer getting more richer. Yep. Does it have any relationship to the world markets? Nope. I don't see making decisions off of that. Can you, make one size fit all so that people with assets and people without assets are equal? No. One size never fits all. So, you can't use those things as fundamental reasons to trade and to invest. I think that's dangerous. I've been warning everybody about that for a while now. These central banks are buyer of last resort, and they have a plan. And they don't exactly tell us what it is, except for they remind us that they want stability. And they seem to also want less manipulation, allegedly, when we know that they're the ones in there controlling everything. So it's a real oxymoron going on constantly. So, 54, you got to be careful about the idea of actually suggesting to invest on real rates, and stocks higher and gold down and so forth. That's a dead end until there's no central banks. And if there's no central banks, then there's probably no world economy. I mean, at this point, they have the blessing of the governments, and they do the bidding for the governments. And so the only way for it to recede is basically for the central banks to slowly, the world economies to grow again, remove the socialism that you are concerned about, that you think is important, like the rich getting richer or the poor getting poorer. You can't remove those things. Well, it doesn't work. We've seen for over, I don't know, since Thanksgiving's coming to the United States and this week, and pretty much that's William Bradford. And he tried socialism back in 16 something, and it didn't work. And he went to capitalism, and our economy exploded for 2.5 centuries until those bozos created an income tax. And so, Mr. Wilson created an income tax and started to slow the world, our economy down. It still grows, but it's not as fast as it was growing since William Bradford and the Pilgrims. So, trying to invest that way is dangerous. It's just flat out dangerous because those concepts don't have any value. They have no history. We have 300 years of history of capitalism versus socialism. And socialism is wrong every time. It's amazing. And capitalism is always successful for growth. So worrying about somebody making more money than somebody else is creative destruction. It's necessary for growth. It's called evolution, really, I guess, in the end result. So if you're into socialism, you're anti-evolution. If you're into capitalism, you're pro-evolution. And I think that's pretty much the whole answer to it in the end. So, all right, this is Doc from North America saying arrivederci, and we will catch you all. Nestor, I'll have to translate that. Doc is out of here. Happy trails to you. We'll see you again tomorrow, that is. And when we meet again, which is tomorrow again, happy trails to you, to all our trading.